Stock Market Documentary Channel presents.
There's a new product in the bond market. Stacy, what is it?
Well, there's a possibility of a product. I came up with an idea because here in London, they found the oldest written language from Roman times here.
Really?
So the oldest dated document in the UK has been found, and it's a bond. Gratus is owed 105 denarii. So this was Tibullus of Venustus owed gratus of Spurius. And I thought, wow, that's a good idea, because right now we're in a global situation where so much of the future has been sold that we're now suffering from what Das calls a banquet of consequences from all of that pulling forward to the now, all of our future consumption. And then I saw the story, and they're great photos that this is just a piece of wood, and it used to be covered with beeswax, and it was a bond, and it was from 57 AD or 54 AD, and this guy owed somebody 105 denarii, and I thought, well, maybe now that we're digging up things like this from the past, maybe they can re-securitize this old bond from 2,000 years ago, and maybe there could be a market in there. I'm sure people are seeking yield. I'm sure they could find somebody willing to, buy this.
Well, Darius from Spurius, he never is going to get his money. This is where the word spurious comes from. It's spurious. It's quite spurious. Poor Darren from Spurius. He never got his bond money. Yeah, it was Goldman Sachs' ancient relatives who created this fake bond and sold it to poor Darren. And then they made a short sale against him ever getting the money, and they pocketed on the early credit default swap, which is not well known. They're going to probably find that in some ancient tomb at some point as well. So the game has gone on since Jesus was trying to root out the money changers, but unsuccessful as he was, we still have this whole concatenation of leverage buyouts and credit default swap pyramid schemes engulfing the globe, and hundreds of trillions, if not a quadrillion worth of worthless derivatives. Oh my God, it's never changed.
It was Gratus of Spurius.
Oh, Gratus. Well, Gratus is also from Spurius. He never got, it's gratis.
Free.
It's free. He never got his money. It's quite spurious. And that's been the pattern for investment banking now for 2,000 years.
And then here's another tweet. This is quite interesting, relating to bonds, relating to interest paid on bonds, relating to bond markets that have been going on, as we see for almost 2,000 years at least. Here was a bond, an actual document here in Roman London found, and now cut to today, for the first time since those bonds were first created, Fitch Ratings estimates that $10 trillion of negative yielding government bonds are costing investors about $24 billion annually. So we've moved beyond gratis of Spurius to costly of Spurius. Like, investors are paying $24 billion per year to governments to borrow. I half think that most of these investors are central banks.
Yeah, gratis from Spurius has been replaced by NERP of Frankfurt, the European Central Bank, and the negative interest rate product, or policies that have. Well, when this originally was pitched, these negative interest rate bonds, it was because these were great deals that people were making money on this death march to the debt-pocalypse, and now people are starting to figure out that it's actually just a wealth confiscation scheme. So they're saying, they stole all this money. A negative interest rate is just a bank taking your money. So that's what it's all about. It's not about creating a policy to keep the economy rolling along in some reasonable manner. That's not it at all. It's just wealth confiscation.
Well, when they say this is that piece of wood found in London, and it said, I, Tibullus of Venustus, owe you Gratus of Spurius 105 denarii. Here, they're like, because he delivered goods worth 105 denarii to Tibullus of Venustus. So here you have investors saying to, the British government, say, if their yields aren't negative, but they would say, here, I'm loaning you $1 million, and you owe me $500,000 back. It's so topsy-turvy. It's just absurd.
Right. They wouldn't have gotten away with that back in those days.
Yeah, because imagine if they find the equivalent of our logs, and there'll be just a log on a computer somewhere.
Yeah.
They'll be like, what the heck were these people? Like, who were these people back in the year 2017 or 15? Where are we? 2016.
Well,
Who are
David
these?
Graeber would posit that this was the beginning of money, is based on credit. So you had a credit event, which is this ancient bond,
Yeah.
which then necessitated the need to pay off this credit, and you would pay it off. You could pay it off in the money of the day or in kind, with goats or services, and that credit came first, then money. So this kind of buttresses his argument there. But as you point out today, we have a situation with negative interest rates where there is no actual positive return of capital, and so future generations or aliens from another dimension would come and visit planet Earth and wonder what the Earthlings went extinct due to negative interest rates. It wasn't a cataclysmic event of the economy or the environment. It was this negative interest rate policy that was introduced into the economy and created an apocalyptic destruction.
It's almost like some sort of discount rate, like with the.
It's Mount Vesuvius of finance. And the Pompeii just was wiped out. It's like the global economy is wiped out by this eruption of negative interest rates.
Exactly, and the UK used to have tally sticks, and that's where the discount rate came from. Is that you got a discount on your taxes, essentially. So it was a negative rate to it. So here it was the opposite in some way. I don't know. But here, continue with the bond market. I want to turn to this tweet from Kate Long, who's a bond market expert, and Puerto Rico is her top market, but she covers municipal bond market. The bad boys of Muniland, ranking states by fiscal condition. And the two worst states, in terms of how much they owe and how impossible it might be to pay it back. The bottom is Puerto Rico, which isn't really a state, but it's a colony, essentially, of America. Puerto Rico and Connecticut. And I realized, what do Puerto Rico and Connecticut have in common?
Do a Venn diagram. What do these two things have in common?
Hedge funds.
Hedge funds. Yeah, it's amazing.
It's remarkable.
Yeah.
So hedge funds drove these two states.
We dived into the big data, and we came up with this figure. We figured it out through data, that hedge fund managers are the problem.
Their bond is our bankruptcy, is what has happened to Puerto Rico and Connecticut. At least Connecticut could go bankrupt. Puerto Rico, there's a big fight happening in Congress about what to do with this because they owe, it's like $75, $85 billion that everybody was lending to them because of the tax incentives. Remember in the last episode we were talking about the voodoo sort of thing, that here the government created this monster of debt there. In Connecticut, it's just run by the financial services sector, all the way out to Stamford and Westport, all these cities that are basically hedge funds, UBS, all these big hedge funds, when you look at the list of the top paid billionaires in the world, Ray Dalio, those sort of guys, they're all there in Connecticut. And they run that government there because the government is terrified, the state government of Connecticut is terrified of them ever leaving.
And that's our friend Paul Tudor Jones out there in Connecticut. He's had to cut his fees because the hedge fund business is not what it was.
Yeah, but in terms of how they control the policies and their bonds and their financial services and their credit default swaps, how their mentality runs the government there, and it leads to bankruptcy. Puerto Rico is also a special case, as they've attracted all of these. The Texas guy, he now lives there. The big Texas hedge fund guy, he lives down in Puerto Rico. They're all moving their operations to Puerto Rico because Puerto Rico allows just a 5% capital gains tax, and there's a special relationship with the federal government, so you don't have to double tax. You're not double taxed.
Bass? The Bass?
Yeah, Kyle Bass. He moved down there. All these.
Peter Schiff?
Yeah. They've all moved their operations down there to avoid the taxes that the U.S. federal government charges on capital gains. They've moved it down there because they're not double taxed on it like every other space on Earth they move. They'll be double taxed by the U.S. federal government.
Well, they're going to require a bailout. So similar to Greece. Okay, Greece was attacked by bankers on Wall Street, and then it required a restructuring, and the ECB and the Troika got involved, and you have the problem that is Greece. Now, Puerto Rico, similarly, it will need a bailout from the federal government.
They'll need a bailout, but they're imposing harsh austerity on the people and raising taxes, raising prices of everything.
To bail out the guys in Connecticut. So the guys in Connecticut are getting a bailout from the federal government because they're investing in Puerto Rico. This simple data point is all you need to know about how the world works today. The government is constantly bailing out the wizards of Wall Street, the masters of the universe. They're constantly screwing up, and the government, your tax-paying dollars, are constantly going to bailing them out. But they mask that as somehow being a policy, and because we need low interest rates to keep bailing out the hedge fund managers in Connecticut who are losing all their money in Puerto Rico. That's our policy. Like we had to lower interest rates to bail out long-term capital management in Connecticut. That's our policy, because somehow it's going to benefit the economy as a whole and create jobs. Well, guess what? There are no jobs being created that create enough taxable income to pay down the massive debts that are being incurred to bail out these hedge fund managers who are losing money in Puerto Rico. So you've got to break the chain. You've got to break the cycle. And I know how to do it. I've expressed the solution many times on this show and elsewhere many times. You need to raise interest rates and put the hedge funds out of business and break the cycle.
It also puts lie to that claim that it's a scumbag workers, that the scumbags who live off food stamps and welfare. Connecticut is the richest state in the U.S. It's the most in-debt state, but it's also the highest income and the highest property right near outside of New York City. So speaking of the scumbag workers that they say it's the cause of all of this, American serfdom companies are offering loans for living expenses to their destitute employees. And this is a new trend across America. Uber's also doing it. Uber is in the subprime car lending business. So basically, they're having troubles finding drivers, for example, because there's a 30% turnover rate within every year. But so many Americans have such bad credit that they can't get a car. So they're actually in the lending business. They're giving them loans to buy the cars, to lease the cars.
It's the casino gulag model that I talk about. So you get into the Uber car after losing your high-paying job to bail out bankers in Connecticut who are investing in Puerto Rico. And to make that work, Uber will go, just sold $3 billion, or $3.5 billion worth of their stock
to Saudi Arabia.
Saudi Arabian investors to offset the need to give a loan to the Uber drivers now who have been disenfranchised to keep the debts income rolling into the pockets of the Uber investors who will see their company now worth $50, $60 billion go public. A few insiders become billionaires on the backs of taxpayer bailouts, disenfranchising the workers, and creating a casino gulag model where life becomes clicking around to make Mark Zuckerberg a few bucks. We got to go.
It's not just Uber. It's many, many corporations across America now having to lend.
That's the model. The model's being adopted. They're pioneers. We got to go to the second half. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Australia. Talk to kangaroos and other crazy beasts. No, we want to talk to Das. He's the author of this book, A Banquet of Consequences. We're going to go into the book with him on a special Summer Solutions episode, so you can look forward to that. But for now, we're going to talk to Das about the drift to autarky. What is it, Das? What are you talking about there?
Well, autarky is a state in economics which is really closed economies, where you're self-sufficient and you don't trade. So it's exactly the opposite of Ricardian trade and essentially the advantages of free trade. And what I'm seeing in the world today is actually a very interesting process which is reversing the last 30 to 40 years of the Washington Consensus, which is basically growth in global trade, growth in global capital flows has underpinned basically growth in global GDP. And some interesting things are going on there, because if you actually look at the last 30 years, global trade has grown by roughly double GDP growth. And at the moment, global trade is static or even shrinking. And that actually means one of two things. Either it'll increase and therefore global growth will hold up, or global growth will decrease and catch up with global trade. And at the same time, if you look at actual money flows are between 50 and 60% down from pre-2008. So things have fundamentally changed. And that's very, very important to understand, because that was one of the underpinnings of growth, and that's reversing for a whole bunch of very good reasons.
All right, so globalization as a trend is reversing. And for a number of different reasons. I mean, you can point to the environment, which is collapsing in a lot of regions, causing enormous strain. There's obviously this terrorism threat that's causing enormous problems and reallocation of capital toward defenses. You know, a lot of money is being spent just to protect people from this either perceived or actual terror threat. Not a lot of people are talking about the environmental consequences, the costs associated with that. So globalization, as you see it, is reversing, and you end up, I mean, are we all becoming like North Korea?
Well, yeah. Well, North Korea is probably the last remaining autarkic nation that's not purely that. They have a phrase for it. They call it juche, and it's a juche economy. And historically, it's not unusual. People think it's a very unusual state. The Soviet Union, for a lot of its history, was basically an autarky. Japan during the Edo period, things like Pol Pot's Kampuchea was basically an autarky. So it's not uncommon to experiment with it. But I think the crucial thing here is to understand why it's occurring, because that points to deeper stresses. And one of the reasons it's occurring is it works really well when growth is going really well and everybody is actually benefiting from it. And the real crucial thing, it's a chicken and egg argument. Because growth has slowed, everybody's trying to maximize their share of it. And so they don't see as much in the way of benefit as they did before. And the classic one is China. Net exports doesn't really add very much to their GDP anymore. It's basically a domestic game. So essentially, their engagement with global matters is getting less. The other thing is, it's actually kind of productive to have a globalized economy under certain circumstances, one of which is if you're trying to actually inflate your economy under difficult circumstances, because there's policy leakage. So if you run fiscal deficits, but you don't make anything, as we don't in Australia, every time we run a fiscal deficit, we suck in more imports and benefit other countries, which are our trading partners. So all of those things are occurring. But I think the major thing that's going to undermine globalization has to do with something else, which is the fact that it's promoted loss of living standards in the advanced economies because jobs, particularly good jobs, manufacturing jobs, have drifted from there into emerging markets. It's boosted emerging market living standards, creating some markets for goods sold by advanced economies, but the benefits are kind of disproportionate. So there is a huge amount of tension between globalization in terms of its benefits for the average person versus a smaller group of people, the so-called elite, if you like, or the very skilled workers who've benefited. And that tension is proving very, very difficult to actually square. And you're seeing that in different ways. And if you actually look at some of the commonalities in some of the political campaigns that are being run. For instance, in the United States, one of the things that comes through in the presidential campaign is both parties' reluctance to embrace trade fully. And similar noises are being made in other parts of the world, which is a real turnaround from the state which existed, say, as recently as 10, 15 years ago.
Okay, let me jump in here for a second, because you mentioned a couple of phrases there. Globalization, obviously. You also mentioned neoliberalism and the Washington Consensus. These are all terms that have been associated with the economies of the deregulatory era, starting with the Reagan-Thatcher years. And we also had another phrase covering those years, trickle-down economics. In other words, the idea being that if you allow the rich to become infinitely rich, there's going to be a trickle-down, and we should deregulate, and we should keep interest rates going increasingly to zero. And to some degree, there was a trickle-down effect because you had asset price increases and you had a lot of new industries open up or opportunities open up, the go-go 80s and the yuppies, et cetera. But from what I'm hearing now and what you're saying here is that that trickle-down is now dried up. Nothing is trickling down, and now you've got a bifurcation, a real split between the top and the bottom. Your thoughts?
I think that's exactly what is happening. I mean, Will Rogers, the famous American comedian, once said that, you know, wealth was all appropriated to the top in the hope that it would trickle down. That's where the phrase actually comes from. But you're absolutely correct. It's not trickling down in the same way, because the wealthy that actually originally were wealthy, if you go back in history, even before the 1980s, were people who built huge industries. The Rockefellers and so forth, the Carnegies, who built massive industries which employed people and basically created wealth which was sort of spread around. But today what we have is the wealth is kind of different. The wealth is to different classes of people. It's to people who are asset rich or sometimes they're actually employees, but well-paid employees in certain industries like technology and finance, two of which would come to mind. So the dynamics have changed in a very material way. And I think that is going to the heart of some of the political tensions that we are seeing. And that actually means that the average person, the average voter, is becoming increasingly reluctant to embrace globalization because to some extent they get cheap goods. But if their jobs aren't there, if the wage growth isn't there, it basically doesn't work out for them. And at the same time, what covered up that was globalization of capital, which enabled them to increase their debt to cover some of those shortfalls. That's less and less available. And underlying this retrenchment is another interesting process. You're happy to lend to people, provided basically they're going to pay you back. And as the Germans have found out with Southern Europe, and particularly with Greece, that all the money they lend is actually at risk and they're not going to get it back. And they're very painfully trying to cover up the fact that they're not going to get it back. So there is actually a reluctance now to extend this credit in the same way. And this is manifested in different ways, like the Saudis and the Chinese are switching away from financial assets into real assets. And that all changes the dynamics of globalization in a different way and leads to realignment of both trade and also in terms of the geopolitical outlook.
All right, well, you're definitely seeing now what I call the global insurrection against banker occupation, or Diabo. You've got it in France. There's, obviously a huge conflict now from those people that do not want to be neoliberalized out of existence. They've been holding on to their values for a long time. Now there's a huge conflict. You see in Latin America, South America, the coup in Brazil is probably part of this. You're seeing it across America. You've got lots of social unrest. So the social unrest is happening. People are referring to 1789 in France or 1913 in Russia. And, they're saying this is a pre-revolutionary era. And for much of the same reasons. You got wealth confiscation, no trickle down. What about these trade deals, Das? I mean, what's the future for something like TPP or TTIP that Obama is urgently trying to get through? It seems like these deals are kind of dead on arrival. But what are your thoughts?
Well, I think firstly, we've gone away from global deals. So the basic global type of deals have gone away. And what we're now into is very, very interesting. It's part of this sort of reversal of globalization. We're into narrower deals of facilitating particular types of trade arrangements, which are bilateral or multilateral. But the crucial thing here is that is emerging in these is two or three things. One is intellectual property, because basically people have worked out that manufacturing, et cetera, doesn't really matter. Trade in goods and services doesn't matter. It's controlling intellectual property. And to some extent, the stronger countries in intellectual property, which is the United States and some parts of Europe, are trying to basically protect their intellectual capital interests. The other one, which is interestingly, is the ISDS provisions, which is the investor-state dispute settlement processes, which, and we actually saw that in Australia, where the Australian government essentially put fairly toxic advertising about the diseases you can get from smoking on cigarette packs. And Philip Morris actually sued the Australian government, not in Australia, but under the ISDS provision of trade arrangements, saying that you can't do that because that infringes on our intellectual property. So what we're seeing is some very interesting tensions, which have nothing to do with sovereign rights, but have to do with corporate rights and protection of intellectual property around the world. And basically, it's about getting access for certain products. And if you look at those trade deals very carefully, they actually favor the stronger parties who are trying to actually get leverage for these types of deals, which preserves their basically franchises and power in the world. So it's a very different type of trade environment that we're creating.
Well, it's so clear when you understand what these deals, these global deals, TPP, TTIP, are about corporate rights deals. Okay, as you've just described it, it's as clear as a bell. And
well, actually, it goes further, Max. If I can just interrupt you on that point. The most interesting thing about some of these deals is the way they're actually written. Because what they do is they allow certain corporations or representatives of trade bodies for industries to actually buy their way in. They pay a certain amount of money to pay their way into the process, where effectively they de facto actually write a lot of these things for themselves. And the process is actually quite secretive. And as we've seen with some of these deals, the full details don't emerge until way, way after they're negotiated. So you're absolutely correct. This is almost like a private sort of arrangement that is masquerading as country-to-country trade deals.
Right, it's monopoly expansion deals. That's what these are, monopoly expansion deals. To refer to them in any other way by any mainstream outlet is completely misleading and an outright propaganda tool. They're monopoly expansion deals. That's what they are. It's not about trade in any sense of the word that people associate with that word. And it's quite remarkable that very few people in mainstream are held accountable for pushing that kind of propaganda. Anyway, Das, I think we're out of time. So we must say goodbye. But thanks again for being on the Keiser Report.
Good to be with you, Max.
All right, well, that's going to do it for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Das, author of Banquet of Consequences. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.
Thank you for watching. Please subscribe to our channel. Stock Market Documentary Channel presented.